Hello everybody, welcome back again. I'm Darren. Alright, today on TikTok Make Me Buy These Stocks, we're gonna look at dividend stocks. So today's title of the video is 3 best dividend stocks. So dividends are one of the sources of incomes or gains that you get from investing, and in this video we'll be watching a recommendation. But of course, just take note, for us, when we are investing in US companies, there is a 30% tax on the dividends. Alright, so you won't be getting the full amount that he is talking about. If not, let's begin the video and let's take a look at his recommendation.
These are the 3 best dividend stocks for your retirement. Number 3 will pay you every single month. With the current inflation rate, dividend paying stocks are more important than ever. So we want companies with a long history of dividend payouts and ones that can survive the current inflationary environment. So we want companies whose products and services are essential. So here are 3 stocks that meet this criteria. The first is McDonald's. McDonald's has been paying dividends for 46 years, and they've increased dividend payouts for the past 32 years in a row.
Alright, so yeah, the very first stock that he talks about is McDonald's, alright, and how he has been paying dividends for a long time and how he's been constantly increasing dividends for the past 32 years as well, alright. And he also did mention that we should be looking for companies that are selling essential products and services, and this is something I agree with. It's just like how a lot of people now are asking, what's a recession-proof stock? And he also mentions that with the current inflation rate, dividend payouts are more important than ever. However, this is something that I need to point out, which kind of implies that if you want to beat inflation, then your dividend yield has got to be greater than inflation, right? So I mean, if we just assume that the long-term inflation rate is 2%, then your dividend yield is going to be greater than 2%, right? So just keep that in mind as we run through the 3 stocks. Right? So the first one, McDonald's. So again, looking at its metrics from the value investing methodology, all right, earnings per share has been positive and uptrend, all right, less 2020 because of COVID, but other than that, it's been on the uptrend. Gross margin has always been positive, uptrend, and greater than 40%. Returns on asset, positive, is not uptrend, and it's almost 15%. All right, return on equity, positive, not uptrend, but more than 7%. Its cash flow has always been positive and on uptrend, and it has a debt to equity ratio of less than 0.5. Okay, so when we're looking at all these metrics, McDonald's fulfills almost all the criteria, right? And it has an annual dividend yield of about 2 to 2.5%. Okay, so as I mentioned earlier, we have to pay a tax of 30%. So 30% of 2 to 2.5%, you're actually looking of a take back of about 1.6% only. In that sense, it doesn't really make sense to us because it doesn't really beat that long-term inflation rate. But anyway, moving on to what McDonald's does. Are they selling something essential? I feel that McDonald's isn't exactly selling something essential as compared to what a supermarket sells, but of course, maybe it's essential if you really love your burgers and fries, alright? And McDonald's has such a very big, or rather strong brand name. It's the biggest fast food chain in the world with the largest number of locations, and it's difficult to imagine another fast food chain actually taking over McDonald's because of this strong brand name, that they've established over the years. So would I buy McDonald's? Personally, no, simply because after I take away the tax, actually I'm not beating inflation. So if I'm looking at from the point of view of finding a dividend stock, then it's a no for me. Moving on to his next recommendation.
Lowe's is an absolute beast when it comes to dividend growth. Their latest quarterly report beat analyst expectations, and they've increased dividend payouts 38 years straight. Their low payout ratio means they can keep growing dividends for a long time to come.
Okay, the second company that he has recommended is actually Lowe's. So Lowe's is a company which focuses on home improvement. So in a Singapore context, right, it's like you try to cross IKEA and Home Fix. So that's what you kind of get. And it's actually very interesting when you walk through their shops like Lowe's or Home Depot, in the US. Actually, when you go in, it's the amount of things that they sell, it's a lot of, how should I put it, a lot of handyman stuff, a lot of things. It's actually quite exciting to walk through. All right, so anyway, just looking at the metrics again of Lowe's, earnings per share, well, positive and uptrend. Gross margin positive, not uptrend. It's about 35% thereabouts. Return of assets positive uptrend and almost 15%. Return of equity positive uptrend but greater than 7%. Cash flow has always been positive and on the uptrend, but it has a debt to equity ratio of larger than 0.5. Okay, so yes, it does fulfill again most of the criteria, not all, but most of it, coming from a value investing point of view. And they have an annualized dividend yield of about 2 to 2.5%. Lowe's has been paying dividends since 1989. Do they provide something essential? I guess the author is actually coming from a point of view where every homeowner would always have some works to do on their house, and Lowe's is actually there to provide that for them. So 2 to 2.5% after you minus tax again, there again you're going to left with about 1.4 to 1.6%. So are you beating the long-term inflation rate? Again, I think not. It won't be an option for me if I'm purely coming from the point of getting a stock for the dividend. So not for me. All right. So his last stock, let's go take a look. His last recommendation
is really special. Only do they pay out every single month, they've increased dividends every single quarter for the past 25 years. So if you're looking for a second paycheck, look no further than Realty Income.
Alright, so the last one that he recommended is Realty Income. Just to say again, alright, the metrics of Realty Income: positive earnings per share and uptrend all the way up to 2020, positive gross margin. It's not on the uptrend, but it's extremely high. It's 90+%, 94%. Return of assets positive, not uptrend, less than 15%. Returns of equity positive, not uptrend, less than 7%. Cash flow positive and on the uptrend, and debt to equity ratio that is higher than 0.5. Alright, so again, Realty Income, it's a company structured as a REITs. Monthly dividends are supported by the cash flow that it rents out, that it gets by renting out all these real estate properties to commercial clients. Alright, and it has an annualized dividend yield of approximately 4%. Okay, coming from value investing point of view, satisfy about half the criteria. It does offer you returns in terms of dividends. They keep mentioning that it's been increasing for the past 55 years and counting. However, again, you have the Federal Reserve raising interest rates in order to fight inflation, and then as a result, it leads to a lower demand in the real estate space, which Realty Income operates in. Would I buy this stock for the dividend? If I'm looking purely from the point of dividend yield, then yes, it is possible to buy this stock. However, would I do it? I wouldn't, again, because it's something which I'm not very familiar or confident in. These are the 3 stocks that we have gotten from TikTok. So if you would like to know whether it's the right time to buy any of the above stocks or any other stock for dividend income, if you want to know when is the right time, join the Value Investing Masterclass to learn more and learn the safe and proper way of investing. Alright, so even if you know nothing, then this is the time for you to learn. This is the place for you to learn. Alright, again, these are all just advice that we have gotten from social media. Please do your own diligence before you invest your hard-earned money. Alright, the sign-up link for the masterclass is in the description below, and that's all from me today, and I'll see you the next time. Bye.